And welcome to this CQS New City High Yield webinar from me as well. As Mark said in the introduction, I'm the chair of the board of independent directors of this investment trust. Our annual general meeting is next week, 30th of November to be exact, and will be held in Jersey because we are a Jersey registered company. Now, Jersey is not the easiest location, so we're holding this webinar to give shareholders and other interested people an update on the portfolio and the opportunity to ask questions. So I'll shortly be handing over to portfolio manager Ian Francis, known universally as Franco, to do exactly that. But just a few highlights from me first. For our most recent financial year, ended 30th of June 2023, the total return to shareholders was a positive 0.2%, thanks in very large part to another year of very attractive dividends. During this period, interest rates rose and many investment trusts, particularly those that are heavily yield-based, saw their discounts widen significantly. So I think this is a very reasonable result, particularly as our dividend was fully covered by income generated from the underlying investments. On the subject of discounts, or perhaps lack thereof, CQS New City High Yield's share price stood at a premium to its net asset value for the entire past financial year. It briefly dipped to a small discount over the summer, but has now returned to a premium of around 4%, and has allowed us to steadily issue shares in small amounts when conditions are right. I'm sure that the attractive yield of currently over 9% is a major reason for our appeal, and I want to thank shareholders for your support and hope that Franco and I may convince those 39% of you who are not yet shareholders to put us on your buy list. Just one more thing before I hand over. You will have seen that NCYF Investment Management has agreed to purchase CQS. That was announced last week. We understand that they are supportive of CQS's investment trust business, and at least for now, nothing will change. Obviously, the board will be very vigilant on how this progresses. So that's me, and I now hand over to Franco for an update on the portfolio.
Good morning, and thank you very much indeed for giving me this opportunity to talk through CQS New City High Yield Fund. Just before we go through to the main slides, I'll give you a brief background to me. I've been 47 years in the city, stockbroking for the first 31 years and managing this fund for the last 16. It is something that I enjoy, and the magic 50 would be a nice figure to reach. Anyway, can we have the next slide, please? And I'll talk you through the rest of it. Right. First of all, this is about CQS. It gives you a sort of feeling as we are at the moment. We are mainly a multi-asset credit platform. We have 55 plus investment professionals, of which 20 plus, I think it's about 23 currently, are investment analysts and credit analysts, which support me very strongly in this. When you're making decisions to buy, sell, or just to carry on holding a position. Obviously, the directional hedge fund part of it will no longer be in the mix as we become part of NCYF, but that's it has no effect whatsoever on our day-to-day running of the portfolio. Next slide, please. Right, this is obviously New City High. Current AUM is 276 million. And this has grown substantially from 16 years ago when I took it over. I think it was around about 50, and then obviously we had the GFC, which was an interesting time to go through. But the main point of this, it gives investors, including myself and Caroline, a high gross dividend yield, and the potential for capital growth. Obviously, the potential for capital growth varies from year to year depending on where credit markets are. currently, you know, over the next sort of medium term, you know, there are opportunities for growth, as you know, when you have you know, higher rates, you know, bond markets have been weak, and therefore, you know, bonds trading below the magic par of 100 are, you know, now more attractive, giving us a very good running yield, and B, you know, the opportunity for a little bit of capital growth as well. Obviously, you know, we are focusing on the very high end of you know, markets for as regards yield. You know, currently, you know, the dividend yield is currently 9.33%, which is obviously paid out after all expenses. And you know, this means that you know, we have to be very vigilant about the companies, you know, we are investing in, and you know, their ability to continue to pay. And you know, we're not scared to get involved if a company is going through a restructuring, or you know, refinancing of bonds, you know, to keep that company, you know, solvent and, you know, working well for us. Next slide, please. This is obviously, you know, on the dividends. You know, we have now grown the dividend every year since I took this bond over. Obviously, the figures at the top of the columns are only to sort of one decimal place, which obviously is rounded up. But you know, we, you know, do focus on the fact that, you know, income is very important, and safe income for investors is number one, purely and simply, because obviously the demographic of a lot of this is my generation and older, and you know, quite a few of the younger generation quite like the income as well. But what you do not want is to have a, you know, large dividend one year and then suddenly find your dividend is being cut the next. You know, for the last couple of years prior to the 2023 year end, in July, we actually used some of our revenue reserves to, you know, to keep the dividend stream going. The revenue reserves still stand at 3.05p per share. So, you know, this knocks in a great opportunity to, you know, keep a sensible income stream going forward. And you know, we add in good years. I mean, you know, there were times, you know, when we were growing dividend quite quickly between sort of 2011 and 2015, where we were putting, you know, a fair bit into reserves purely because you know, in my career, you know, I have seen, you know, the opportunity for disappointment to come and bite you if you pay everything out. Certainly in the sort of late 90s, early 2000s, this was the case in a lot of markets. So, you know, the reserves are there to be used to, you know, support the dividend if necessary. And you know, if many years in the future, you know, rates are much lower and, you know, the opportunities are not there, then, you know, this, you know, does help you, you know, get through this. Next slide, please. This shows my total return performance since 2007. You know, the reason I put in the all share index is because you know, so many fund managers allegedly never beat the all share index. You know, both ourselves and our main rival, if you like, Invesco Bond Fund, you know, have beaten it, but you know, we have, you know, somewhat outperformed, you know, all and sundry. And obviously, the very nasty dip in February 20 where we went to a quite a large discount, was short-lived, and the NAV didn't fall anywhere near that far, but this is the the actual market price. So that does, the market is a voting mechanism, and the market was panicking at that time. But we have gone back to being on a what we consider a sensible premium, given all the hard work and effort that the whole team here put in, to keep that income stream strong and the capital as safe as possible. Next slide, please. This shows you, our investment process. Obviously, we use Bloomberg as our primary tool for pricing, and it's a very good search engine as well for monitoring where the yields come from. If we have new bonds coming, being issued all of the time, and we look initially at the yield, because there's no good to me if somebody's bringing an investment grade bond yielding 4.5%. It doesn't pay the bills or the dividend. We are obviously focusing very much on bonds which are around and above our dividend payout, and we're also very, very aware that we're not going to switch capital into income. This is here really to preserve that capital. So what we do, we look at all the fundamental research that comes in from the sell side. Our internal analysts are doing consistent and continual analysis across the complete capital structure, which does also include looking at the equity alternatives in there, because we do have within CQS a substantial convertible division, and that is also very, very important when you're making a decision. And as I said, the independent broker verification is basically what's coming in from the sell side. What we then try and do is look for it to have a diversified portfolio. Obviously, there are some sectors which have the yield which suits us perfectly, and obviously we are heavier weighted in those sectors, but we do also look closely at not being too overweight in illiquid sectors where should things go wrong, you're not able to get out. Next, we obviously we're looking at it every day. So that, there isn't a day that goes by when we're not looking on our sort of Bloomberg's various news feeds, because even when you go out at a weekend, you're looking for where people are spending money, what's happening, and yes, we're constantly monitoring the geopolitical element as well, which has been a little interesting of late. Next slide, please. Right, this shows where we have the opportunity to pick up the income. Financials, which is majority of which is banks, insurance companies, and companies providing various other services, there is the biggest. Obviously the majority of those are UK banks, which are financially and credit wise very strong at the moment, and post, restructuring many of these banks since the GFC, they offer a fantastic, high yield opportunity. Energy is obviously, we have exposure towards transitional businesses like gas producers. Yes, we also have one or two oil businesses in mostly in the North Sea, which is the strictest regulated area in the world, and energy also in this case includes shipping with oil tankers such as VLCC Business Frontline, which I'll talk about a bit later. Then industrials again, which can be partially there's businesses in there that do heat pumps, for example. So we are focusing on what's happening there. Consumer discretionary, hotels would be our largest exposure there. Consumer staples, that will be businesses like Co-op PLC, not the bank, Boparan, the chicken producer, and REA, the palm oil business in Indonesia, which I'll talk about later. Real estate, basically that is all UK REITs. Obviously, it's that they've had a hard time with high rates, but a lot of them are now starting to come back again. And materials and IT are smaller. IT is actually, a lot of them are gaming companies in Scandinavia, which produce games for a lot of German sort of online platforms, and they offer higher rates of return than we would get in the UK. Next page, please. Right, this comes into the other element that I take a very close eye on, is the currencies. Whilst all of our liabilities, as in borrowings, dividends, and basically performance figures, are in sterling, we do have exposure to mostly the US dollar and the euro. Now this comes in very handy when you have blips in the UK economy, such as we had sort of just over a year ago with the Liz Truss Kwasi Kwarteng sort of debacle, which took sterling down from around the 124, 125 mark to about 10, I think 104, I think was the lowest print. But what it does, it allows us to gain capital when that situation occurs. And we did actually, when it got down to 108, we did sell some of our dollar positions back into sterling, to take advantage of the capital gain and the opportunity to pick up income in sterling, because obviously rates went flying higher. Similar with the euro, but the euro and sterling are much more closely aligned than we are against the dollar. And the other is mostly Scandinavian currencies, Swedish krona being the largest and Norwegian krona the second largest. Next slide, please. Right, here are the top 10. Obviously, Galaxy Finco is actually, I wouldn't expect you to know the name of this company because it's actually domestic in general, which is provides guarantees and maintenance for washing machines, dishwashers, and general white goods. It's been a very, very long, stable business, and has been in the fund for a long time, because they obviously refinanced this a couple of times over our holding period. Number 2 on the list is Shawbrook, which this is more of it's a challenger bank which focuses on buy-to-let and SME lending. It's not well known because it's owned by private equity, but the actual performance is absolutely fine. It allows me to sleep at night. Co-op, well, it's the most ESG friendly bank. We've just literally rolled over refinancing, which actually it was completed today. We now have an 11 3/4 tier 2 bond, which works very well for the business. Virgin Money, yes, again another bank with a good investor base or creditor base, similar to Shawbrook. Aggregated Micro Power is one that you've probably never heard of. This one, to me, is very interesting. It provides a lot of green biomass boilers to schools, libraries, and many public services, and also provides sort of power to the grid when stuff such as wind power and solar are not working too well. Frontline is the VLCC business. It's owned by John Frederickson, he's the biggest shareholder. We did prior hold Euronav, which these two were going to get together, but Euronav also had a high yield, but we have switched into Frontline because the business is better run. It's a greener fleet. All the fleet's got scrubbers, which take out the sulfur content of the fuel, and they are actively looking at improving from there as well. And from the time we did this switch a couple of months ago, we are already quite a few percent above performance-wise where we would have been had we stayed in Euronav. REA Finance is a palm oil business. Before I hear a large intake of breath, it is spot sort of certificated. It's a very green business. They got a score, I think, recently of 87%, which put them right at the top of palm oil producers. They don't export palm oil. It is all used in local markets for the locals. They provide some very, very green power from them methane extraction plants, which are linked to their mills, for local villages, and they also have orangutan reserves. So it's it ticks all the boxes in the ESG, and their bonds actually are on the London Stock Exchange, showing the green leaf, which is particularly green. Stonegate Pub, I don't think that needs any sort of introduction. Whilst pubs are a shrinking market, they still have a lot of assets that they can sell and continue to sell. So again, we're quite relaxed with that. Barclays, I don't think that needs any explanation. Mangrove Luxco actually is the heat pump business. This is a German business, and it is very much in use with the the current transition to greener energy use. Next page, please. Right, this is the last major one from me. This shows obviously the premium since I took this over. I took it over on about a 4 or 5 discount on the beginning of August in 2007. Yeah, and apart from a few sort of odd times in markets, or that it has sort of traded at an average premium 5.6 over the period. So one would hope that we can keep working hard to produce this. Obviously, number one reason for this is the yield we provide and the certainty that we can put our hands on our hearts and say we can keep doing this. And we have the support of a very, very good board who understand the market. I mean, Caroline is quite modest, but she was running multi-asset portfolios and investments at HSBC as part of her CV, which, believe me, is not an easy job. So having her as a sounding board is very useful for me. That basically is me completed as regards the thing, and it is now really yes, to me that's all I need to say. Any questions, please go ahead.
Thanks very much, Franco. Very interesting presentation, and well done in your tenure over the high yield fund. It's certainly done very well for its investors over the years. So that's excellent. Can I just remind any delegates, if you want to ask a question, just click the Q&A button at the bottom of the screen, and you can type your question into the box that then appears. Thank you. So far we have one question, just a question relating to slide 5, where you show the comparative performance and the all share index. Was the all share index shown on a total return basis as well? Sorry, Ian, you're muted at the moment.
Sorry, yes, they're all on a total return basis. Fine,
thank you very much. Okay. Then I'll just ask you something whilst we're waiting to see if anyone else has any questions. It was a bit disconcerting what happened with the Credit Suisse AT1 bonds. I hope you weren't holding those, and I'd just be interested in your thoughts on that saga.
Yeah, well, we did have some of those. I mean,
right.
It was the to be fair, it's the biggest bank in the European credit markets at the time. Elsewhere in the CQS, their positions were quite much larger. Ours was well under 1%, actually less than 0.5%. But it worries me when politicians can change the rules and just totally ignore the terms and conditions of bonds. I think PIMCO is still going to the courts, and obviously they were the largest holders of this bond, but all of the tier 1 credits. I just think it's wrong. Politicians should not be getting involved. By and large, it was a liquidity problem. It wasn't a credit problem. And one minute you're saying you're going to provide liquidity, and then you don't, and you slot it into another bank, and all the debt gets written off, but the equity remains in place and got it with a haircut. Just it doesn't smell particularly nice, does it?
No, quite. It was a bit of a shocker, that one, as you say, with the sort of terms and conditions that you understand being overridden for as you say, political reasons, presumably. We've got quite a few more questions now, so let's run through those. So Adrian is asking, can you give an estimate of the potential pull to par from the portfolio that you have?
I can have a quick look at that now. At the moment, what I tend to do is I look at the top 20 bonds, and most of those are trading under par, which is hardly surprising given where we are in the market. Given the duration of the actual portfolio is 3 years, just over 3 years, which is
right.
a useful point.
Yeah.
And if you look at where we are, the pull to par in sort of 3 years or so, I would say the average, crikey, yeah, the average is going to be in the 92, 93 mark. So therefore, there's 5 to 7% upside, pull to par. Maybe more, but
yeah. So that's a good potential for capital gains in the portfolio there, assuming you hold those to maturity. Good. And you answered the second part of the question there about the duration. So thanks very much for that. Okay, we'll move on to the next. And that was the same as the. Well, there's a supplement to that question. Given, well, do you think we're currently at peak interest rates, and if so, are you moving to longer duration instruments?
Yes, I do think we are very close to peak interest rates. Those investors that read my monthly fact sheet know my view on the ability of central banks to over egg it on, over tighten and over when they sort of loosen rates as well. I think they are learning. I think they've learned this time. I mean, in my opinion, they didn't need to take the UK rates above 5 because of the delay, but that they've done that.
They do always seem to be behind the curve.
They have, and not as bad as in the past.
Yeah,
not as bad as in the past. Those of us that in markets in 1992 do remember, the moment when we had rates going to ridiculous levels,
yes,
and then back down again to try and stay in the RM.
Yes,
but no, I think I wouldn't. They're now saying higher for longer, which obviously they are petrified about inflation, quite rightly, because although it's not the huge part of inflation in the manufacturing sector, it's a much larger part in the services sector. When you get sort of incomes growing by 8 to 10%, that's going to have a knock on to inflation. But I think if you can keep rates lower and inflation is coming back, then you can prudently start to reduce rates. When do I think they will do it? Cynical me, about 6 months before they're going to call an election. But of course, they have no input into the Bank of England, do they?
In theory, yeah.
In theory,
yeah. So are you confident that inflation has also peaked and is going to continue on a downward trend?
Yeah, I think by and large, we had that lovely low print of, was it 4.6% last month. Will we get down to 2? Probably that's going to take longer than people think. But if we can get down to have inflation around the 3% mark, I think that would be a growing economy and plenty of people actually in work, paying their various taxes, and we can survive. The only obviously that is always subject to geopolitical risks, which it looks like we're starting to see them shrink already in the sort of Israeli sort of Hamas conflict, but the jury's out, and obviously, it's been very, very quiet on the Ukraine front whilst everybody's been focusing on this. So yeah, watch out for the geopolitics, because they're the bits that can bite you.
Yeah, that's certainly true. Thanks for that, Franco. So John asks, well, first of all, we'd like to congratulate you on the robust performance of this fund through thick and thin, which I think is a very fair comment. How confident are you that the very high level of yield is sustainable looking ahead?
Yeah, this is a question I've been asked the whole 16 years I've been running the fund. There are always opportunities out there. You just have to keep a very, very close eye on the companies that are where the opportunities are. For me, the next 2 or 3 years I think is going to be no great problem, because although rates will start to come down, we're going to end up with if we end up with interest rates falling to say 3.5% or so, yeah, it's not going to affect us for the next 2 or 3 years. But if you look much far past that, we will have a Labour government in the UK probably. I don't know what's going to happen in the States, but again, these are other elements that you can have an effect on the portfolio. But I feel that we can sustain it, and as I mentioned in the dividend element, we have got reserves which are there to be used. They're not there as a badge or a medal to pin on the chest. They are there to be used should we need them.
Thank you. And then Ian is asking about well, your views on inflation you've already covered, but how does inflation impact the fund?
Obviously, high inflation is always bad for bonds. Obviously, falling inflation is a positive thing. You're going to get recoveries in companies' equity performance, and although your bonds are effectively fixed and they're right in front of equities, if you've got an equity behind it that is particularly strong, paying large dividends, then guess what? The credit quality of the company is improved. So lower inflation should mean better credit qualities, and we'll end up with a positive pull to par, which we've previously mentioned.
Mm-hmm. Yes, so there's certainly opportunities for capital gain potentially. So Neil, I think, is asking a question which refers to your long history with the fund. Have you been in a position where you've had to take on greater risk to maintain the yield, and is that avoidable?
You try and at the end of the day, if you start getting wrong sizing the risk, you are leaving yourself open to being bitten. Yes, we have had bonds that like Credit Suisse that have gone the wrong way. We had Raven Property in the portfolio, which was Russian warehouses in St. Petersburg. Well, neither of those could you see coming, but they were with the Raven, they had very, very good cash flows, and it's the politics that bites you. But you can do all the credit work you like, you can't avoid the politics. But the more work you do in the credit, the less likely you are to get bitten.
Yeah, and I suppose part of the answer is diversification, not to have
Exactly.
too large positions in any one instrument. Good. Excuse me. Then coming back to political matters, as Ian comments, there are very high levels of government debt in the UK and US. How does that impact the opportunities in the market? Excuse me.
That's all right. Because you've got the QT, but in particular, which is now the sort of the way things are going. You have lots of sellers of high quality debt out there, so that's going to hold rates up. Of the yields you're getting on government paper, everything is priced off government paper. So hopefully, rates will. It leaves us with opportunities there for longer.
Yes, so there's plenty of supply of that debt, so it's going to be difficult for demand to keep up, which should keep rates relatively high in the bond market,
Yeah.
as you say. Yeah, that makes sense. Right. And then final question so far. Just remind people, if anyone else would like a question, please post it now. Are there any areas or sectors that you're avoiding, and if so, why at the moment?
I'm not particularly avoiding any sectors, because there's always an opportunity even in a sector that you don't have exposure to. Obviously, whilst we're in REA as a palm oil business, because it's, if you like, local, it has all of the green sort of requirements that anybody wants. ESG is something now that we have to really focus on, and whilst a sector might be looking okay, and you've got you might be offered a high yielding instrument in that sector, but then once you do the work on the company, it doesn't necessarily give you the sort of comfort of investing. I for one are very happy that they're going to try and get a more unified view on ESG across the board, because there were just too many opportunities. Some companies were okay under one system and not under another. So I think the ESG is the reason we wouldn't get involved in certain sectors.
Okay.
And I'm just seeing one. Yep.
Yes, I think it was REA that you just mentioned, wasn't it? Or
yeah, I do have the 9% pref as well as the 8 3/4 loan stock. Yes, I do. REA currently, the pref has 7 points of arrears in it. They are doing a disposal which should be through first quarter 2024, and they will look to be repaying those arrears. Now, preference shares are treated as equity, but at the end of the day, it's still a prior charge, and preference shares that like REA, which they have to pay the arrears rather than just ignore them, are quite a sensible way to get involved in the preference market. I look at prefs on a regular basis, and when they come into the right zone for the portfolio, then we'll look very seriously, because at the end of the day, there's still a prior charge, and it can be give you a great opportunity, despite what has happened in the past with one or two companies trying to sort of redeem their preference shares at par when they were trading in the 150s, which we're talking about sort of the I think that was the Legal
Aviva,
General.
wasn't it?
Aviva, that's right,
Yes,
Aviva.
yes.
I mean, but
That
and
was
they
a
lost that
shocker.
one.
Yeah,
They lost that one.
Stock had something to say about that, and fortunately got headed off at the pass because
Yes,
it a very bad message.
It was a very bad message, and I must admit, we tried to buy them when they fell, but fortunately, and I'm very pleased that not many investors did sell when they sort of crashed out sort of 25, 30 points, which was obviously market makers avoiding taking any inventory on because they probably didn't understand how preference shares worked. But those of us with have been around a while, remember.
Quite. Well, thank you very much, Franco, Caroline. I think that about wraps up the questions. We really appreciate that, and very well done with the fund. Long may the performance continue.
Right, that's fine. Thank you very much indeed.
Thanks, and thank you, Caroline.
Thank you.
Say goodbye for now.
Thank you very much.